Is NIO a buy, a sell, or a hold? That's the question on every investor's mind as the electric vehicle sensation takes a wild roller coaster ride on Wall Street. Just recently, NIO stock experienced a jaw-dropping 17% plummet in what's being described as its worst performance in 4 years. If you're a NIO investor, this is no minor event, it's a financial shockwave. Now, according to investor sentiment from MarketBeat and Business Insider, the consensus rating for NIO stock right now is a rather cautious hold. It's not exactly a resounding vote of confidence with 7 holds and only 3 buys among analysts. And the numbers get even more intriguing. The average 12-month price prediction for NIO stands at $12.68 per share. But here's where it gets really interesting. The high-end prediction soars to an optimistic $19.20, while the low-end prediction takes a dive down to a worrying $7.50. Now, this isn't just about numbers, but what these numbers mean for your investment. Will NIO make a remarkable comeback, or is this the beginning of a downhill trend? We're about to uncover the reasons behind this sharp decline and what it means for you as a NIO investor. So, fasten your seatbelt because this is a ride you won't want to miss. NIO is a Chinese electric vehicle company, and if you're not familiar with them, let me tell you about this company. NIO specializes in making electric cars, which have been around for a few years. They're known for their sleek, high-tech vehicles that run entirely on electricity. It's a company that's generated quite a buzz in the EV world, and its stock has been closely watched by investors. So, if you're interested in electric cars and the companies that make them, NIO is definitely one to keep an eye on. Now, the first thing you know is NIO decided to raise a whopping $1 billion by offering something called convertible senior notes. Now, don't let the fancy name throw you off. These notes are basically like I.O.US that NIO is selling to people, and they come with a twist. Half of these notes are due in 2029, and the other half in 2030. So, if you decide to lend NIO some money by buying these notes, they promise to pay you back, but not just in cash. In addition, NIO says you can convert these notes into their company's stock, which means you could become a shareholder. Now, why would NIO want to do this? Well, NIO's been burning through cash like there's no tomorrow. They're spending more than they're making and need a financial boost. They plan to use some of that $1 billion to pay off some of their old debts, like paying off your credit card with a new one. The rest of the money? NIO says it's for general corporate purposes and to strengthen its balance sheet. In simpler terms, they want more cash on hand to ensure they don't run into financial trouble. But here's the twist. If a lot of people decide to convert those notes into NIO shares, it means there will be more shares in circulation. When there are more shares, each share you own represents a smaller piece of the company. In other words, your ownership in NIO could get diluted, like a glass of juice with too much water. So, while NIO's move might help them in the short term by raising cash, it could also mean existing shareholders end up with a smaller slice of the NIO pie. NIO stock didn't react too kindly to the big news. When word got out about those convertible notes, the stock took a nosedive, dropping a whopping 17.07% in just one day. That's a big hit, and it's the worst performance NIO's seen since it first went public back in 2018. Now, if you take a look at the bigger picture, things aren't looking so hot for NIO this year. Since August, its stock has been downward, falling by about 44.7%. That's a pretty steep drop, and it means the value of NIO's stock has taken a hit. When it comes to NIO's financial outlook, experts have some less than rosy predictions. For this current quarter, they're saying NIO might end up with a loss of around 45 cents per share, which is about 25% worse than last year's quarter. That's not the kind of news you want to hear if you're an investor. And if you zoom out to look at the whole fiscal year, the consensus estimate is even more concerning. It suggests that NIO might see a year-over-year change of negative 37.2%. That's a pretty steep drop, and it's got some people worried about the company's overall performance. Adding to the gloomy outlook, there's this thing called the Zacks rank, and right now, NIO's sitting at number 4, which means it's in the sell category. That's not exactly a vote of confidence from the analysts, and it's mainly because of those recent changes in the consensus estimates. But hey, before we continue, we just want to thank you for watching this far. Moreover, it's crucial to keep a close eye on a company's financial health when making investment decisions, and revenue growth plays a pivotal role in this assessment. Basically, a company's ability to increase its earnings over time is closely tied to its revenue growth. In NIO's case, there's a glimmer of hope as the consensus sales estimate for the current quarter indicates a year-over-year change of positive 44%. This could be seen as a positive sign for the company's financial performance in the short term. However, it's important to remember that recent results might not always match expectations. For instance, NIO's last reported results didn't align with consensus estimates. their revenues fell short of the expected mark by about 10.71%, indicating a deviation from what analysts had anticipated. Similarly, their earnings per share didn't meet the consensus, with a negative 41.67% surprise. Now, here's where it gets interesting for investors. It's not just about the numbers, it's also about how the market values the company. It is crucial to evaluate NIO's valuation multiples, price to earnings, price to sales, and price to cash flow. These metrics help determine whether NIO stock is fairly priced, overvalued, or undervalued. Again, this massive drop in NIO's stock price is the worst it's seen in 4 years, and it was a tough day for NIO investors. The stock took a real hit, plummeting by a staggering 17.07% in just one day, which is never good news for anyone holding NIO shares. However, there was a bit of a turnaround in pre-market trading, where NIO stock bounced back by 2.8%. It's a small recovery compared to the big drop, but it shows that there's still some resilience in the stock. Now, you'll notice some differences when you look at NIO compared to other Chinese electric vehicle makers like Li Auto and XPeng. While NIO had a rough year so far, with a 12.3% drop in its stock price, its peers, Li Auto and XPeng, have been on a different path. Li Auto's stock has actually gone up by 88.2%, and XPeng's shares have risen by 76% year-to-date. So, if you're considering investing in the Chinese EV market, it's essential to keep an eye on how NIO stacks up against its competitors. These numbers highlight that NIO has faced some unique challenges, and it's worth evaluating why its stock hasn't performed as strongly as its peers in the same industry. And that's it. It's clear that staying informed about what's happening with NIO's stock is vital. The world of investments can be unpredictable, and developments like the recent drop in NIO's stock price can have a significant impact on your investments. So, make sure to keep an eye out for future updates on NIO and the electric vehicle industry. The market can change rapidly, and being in the know can help you make informed investment decisions. And speaking of staying informed, what do you think about NIO's recent price drop? Are you concerned about its performance, or do you see it as an opportunity? Let us know in the comments section below. Before you go, make sure to smash the like and subscribe buttons down below. Additionally, if you want to know more about NIO stock, I highly recommend watching this fantastic video. Just click this video right here. Thank you for tuning in, and stay tuned for more exciting content in the future.